I mean, of course, most of these data get revised on the way back, right? I mean, the NBER calls a recession much later than it actually happened. So you might be in one and the NBER isn't telling you already. I had a look at 4 out of the 7 recessionary indicators the NBER uses, because people need to understand it's not as simple as saying 2 quarters of back-to-back negative GDP growth prints to say we are in a recession. So they actually use 7 different measures. And I think that's a much more comprehensive assessment, because they look at the labor market, they look at the housing market, they look at the services sector, the consumer spending, et cetera, et cetera. Actually, today, as we speak, 4 out of the 7 indicators the NBER uses are actually consistent with the recession today as we speak. But there are 3 that clearly aren't. And those are the labor market and the services sector in particular. So what we see today is quite a weak economy, but the weakness is not broad enough to call it a recession yet. Now, this is leading many people to say, well, if we haven't seen it so far, then probably we won't get it at all. And I don't agree with this statement. I just think it's going to get a little bit delayed, and that the weakness from the manufacturing sector into the services sector is taking a little bit longer to play out. And we can talk about why, but it is going to happen. And one last thing. In 2008, the home builders index in the US rallied 50% 2 times. In 2008, amidst the worst housing recession in modern history, the home builders index managed to rally twice by 50% in the same year. Why am I mentioning that? The stock market isn't the economy, neither on the way down nor on the way up. So people are actually confused, I think, because the animal spirits that have been raging in the stock market, take this artificial intelligence mania, or even home builders right now, they have rallied 45% from the lows. Does that mean the housing market is fine? No, that actually means animal spirits are building back in markets, but the stock market is not the economy. And that's something people should always keep in mind. Consumer spending and employment. Those are the 2 brackets, let's say. They contain 3 sub-indicators. Those are the 2 components of the economy that haven't deteriorated enough to be consistent with the recession. Now, does that mean that the labor market is booming? No. Does that mean that consumer spending is booming? No, but it is not consistent yet with the recession. So on consumer spending, we see mixed data. We see retail sales adjusted for inflation that have been negative for a bunch of quarters in a row. But on the other hand, we still see, employment being relatively okay. We are not having acute layoffs yet. In order to have a recession, you need to have companies laying off people. What's happening in the labor market right now is that you see that continuing claims, jobless claims, are finally heading a little bit higher, but they're not yet consistent with the recessionary levels. Why is it taking so long for the labor market to weaken? I think it's a couple of reasons. The first is, look, if you're a company, this is the cycle you go through. 2021, sales through the roof, revenues through the roof, margins are extremely ample, you make a ton of money. You look to hire people, right, when you're making money. You go and hire people in an extremely tight market. Labor supply isn't there. People have retired out of crypto gains, real estate gains, and so on and so forth. So it's very hard to hire skilled people. You manage to hire them, and then the cycle slows down. And when the cycle slows down, David, in 2022 and early 2023, because it was so hard to hire these skilled people, the first thing you're going to do is not to fire them. The first thing you're going to do is to cut your discretionary spending. You're going to cut your advertising spending. You're going to cut stuff that you can cut, but you would want to preserve this skilled labor, which was so hard to hire in the first place. That's a practice called labor hoarding. Okay, so companies are sticking to their core employees. They don't want to let them go because they experience such a tight labor market to hire them. And that's where we are today. But let me ask you something. With earnings per share on a year-on-year basis already down 4%, in the first quarter. So with a slowly but surely earnings recession on the door, and your profit margins also compressing in the second half of the year, are you going to be able to have all these people employed, or are you going to be forced to cut some of this long-term workforce, skilled workforce you have? You probably need to cut your core spending at that point. It's just taking a little bit longer, also due to some pandemic distortions, but I think the labor market is weakening, and that is evident. And I think the trend is going to continue in the second half of the year. Let's explain how this dynamic works. So the yield curve has inverted a year ago, and it has remained inverted for 12 months. And people are very scared of these curve inversions, and they expect that to lead us into a recession. Why is that the case in the first place? So when the yield curve inverts, that's because the Federal Reserve has strict control on the very front end of the bond market. So that's 1 to 2 year interest rates. They control them by simply setting where the Fed funds rate are and telling us where they want Fed funds to be. So if you listen to Powell today, he's telling you Fed funds are at 5, we might want to bring them to 5.5, and we are not going to cut interest rates in 2024. He has a very strong impact on when 2-year Treasury yields are trading, basically through Fed funds. But if you look at the back end of the curve, your 10-year interest rate that you mentioned, that part is rather influenced by other factors: demographics, productivity, long-term growth, and inflation prospects. And the reason why the curve inverts is that bond market is telling Powell, yes, dude, you control the front end, you say where 2-year interest rates are, but we expect that tightness in monetary policy you're applying to make a lot of damage to the economy long term. So from year 3, 4, 5, all the way until 10, we expect lower growth and lower inflation, which means that 10-year yields move lower, lower, and lower, and the curve inverts. And people then expect immediately a recession after that, but my research shows that it is really variable. How long does it take between the first inversion and actually a recession occurring? It can take anywhere between 9 months to 24 months before that happens. And it is the steepening after that inversion, what you just mentioned. So the inversion from, you go to minus 100 basis points between 2-year and 10-year yields. The moment you move back up to 0, that's when a recession is occurring. And the mechanism behind that is that 2-year interest rates at that point are dropping very rapidly. So the tightness in the front end doesn't exist anymore because something has broken. The moment it becomes apparent that something has broken, then 2-year interest rates need to move all the way down and the curve can re-steepen again. Then you are literally in a recession at that point. The latest summary of economic projections of the Federal Reserve is a picture-perfect soft landing projection. GDP growth 1%, so below trend, but not recessionary, and core inflation moving down. The underlying assumptions are, first and foremost, that the housing market is going to be fine. Residential investment as a percentage of GDP was really negative heading into this year because high mortgage rates had really slowed down housing activity. But as in the first half of this year, actually, we have seen housing kind of stalling, it isn't dropping anymore as hard as many people thought. And that has led the Federal Reserve to believe that the housing market will actually be fine. Then the moment the housing market is fine, you can also expect construction activity to pick up, and also all the GDP activity related to housing picking up again against your previous bleak forecasts. I personally think at this moment, the sentiment around housing is very similar to what we had in 2008, with this 50% plus rallies in home builders I talked about. I mean, everybody seems to assume that all of a sudden the US housing market works completely fine with mortgage rates in the 6.5% area. You just run the math, then you can realize that that isn't the case. With the median house price where it is and mortgage rates where they are, it is impossible to sustain a healthy housing market as it was in 2017, 18, 19, and 20, because the mortgage installments are too high. If you ask me how did the housing market manage actually to stabilize in the first half of the year, it's pretty simple. Latest statistics published, I think just today, show that the housing listings in May were the lowest on any single year's May over the last 30 to 40 years. So basically, people aren't selling the house anymore. They are simply stuck with their low mortgage rates. They don't want to sell. Selling means buying another house with a new mortgage rate, which is much higher. So they're basically stuck where they are. So they don't sell. And there is obviously a little bit of inelastic demand for housing. I mean, people need to relocate, people die, people have to go to university. So the sticky demand against such a tight supply of housing is making house prices kind of stabilize. But in a market that isn't alive, in a market that is frozen, with mortgage rate at 6.5%, for how long can this fragile equilibrium actually go on? I don't think for too much long.